Okay, I have a very serious question to start us off today.
Oh, yeah.
It is the question lurking in, the comments section of every Reddit thread, every Twitter post, and probably in the back of your mind right now.
Let me guess.
Where is my Lambo?
I had a feeling you were going to start there. The elephant in the room.
I have to. Because, look,
Yeah.
let's be real with each other. It is January 2026. We were promised the moon.
We were.
We were promised that 2025 was going to be the year of the super cycle, the blow off top, the fireworks. We were told to expect Bitcoin at, what, 250,000, maybe even $500,000.
And altcoins going 100x overnight.
Exactly. Instead, we got chop. We got consolidation. And I think a lot of people listening are looking at their portfolios and thinking, did I miss the memo? Did the market break?
You didn't miss the memo, but you might be reading from an outdated playbook. If you're feeling frustrated that your portfolio didn't 100x, you aren't crazy.
Okay.
But you're looking at the wrong data. The market hasn't broken, but it has. I'd say it's changed species completely.
Change species how? Because to me, it just feels like the game got harder.
It did get harder, but for a specific type of player, the Moon Boy era, it's dead.
Dead.
It's been replaced by the suit and tie era. I mean, we have moved from the casino to the boardroom.
Right.
So this deep dive is about understanding why the market feels so different, why the old rules, specifically the 4-year cycle, are effectively broken, and honestly, why that might actually be the best news possible for your net worth.
Really?
Yeah, provided you stop trading like it's 2021.
Okay, that is a big claim. The death of the 4-year cycle. Let's unpack that first. Because for the last decade, the halving has been practically, religious doctrine in crypto.
Oh, it's the gospel.
It's the calendar we all live by.
Right. The code cuts the supply of new Bitcoin in half every 4 years. Supply shock happens, demand stays the same or grows, number goes up, everyone gets rich, rinse and repeat.
Exactly. The green, 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 red meme. I saw that chart everywhere. The idea is you have 3 up years and 1 down year. But 2025, that was supposed to be the peak green year, the God candle year. And it ended up being, well, kind of beige.
It broke the meme. And this is where the Wintermute analysis is just absolutely fascinating. They aren't just saying 2025 was weird. They are calling it...
What, that the 4-year cycle is dead?
It's dead.
But why now? I mean, the math of the halving is still the same. The supply was cut. Why did the price react the way it always has?
Because the scale has changed. This is the crucial context. Alex Thorne from Galaxy Digital puts it perfectly. Bitcoin has graduated. It is now a macro asset.
Meaning it cares more about what the Federal Reserve is doing than what the Bitcoin code is doing.
Precisely. Think about the math, right? In the early days, cutting the daily issuance of Bitcoin massively impacted the available supply relative to demand.
Of course, but today...
Reducing daily issuance from 900 to 450 coins it's a drop in the bucket when you have billions of dollars in daily trading volume.
So the supply shock is just diluted by the sheer size of the market.
Exactly. It's like throwing a bucket of water into a swimming pool versus a bathtub.
Right.
In the bathtub, you notice. In the Olympic swimming pool, the water level barely moves. What moves the needle now isn't a scarcity algorithm. It's interest rates, fiscal spending, global liquidity. We are waiting for Jerome Powell to print money, not for Satoshi's code to execute.
That makes sense, but it's a hard pill to swallow for people who built their whole investment thesis on that 4-year clock. It feels like the cheat code was disabled.
It was, but Wintermute highlights another layer to this broken cycle that explains the specific frustration of the retail investor, the guy holding the altcoins.
Okay.
They call it the walled garden problem.
That sounds a bit dystopian. What does that mean in this context?
It explains why your altcoins, the smaller, riskier assets, didn't pump while Bitcoin was doing relatively okay. In the old cycle, we had the wealth effect.
Right, the trickle-down.
Money would flow into Bitcoin, profits would be taken, and then that money would trickle down into Ethereum, then Solana, then the smaller caps.
The rising tide lifts all boats. The profits rotate.
Right. But in 2025, that flow was severed. Why? Because the new money entered through ETFs.
Ah, the institutional rails.
Exactly. Imagine a pension fund or an investment advisor buys the BlackRock Bitcoin ETF. That money is legally and structurally stuck in that ETF wrapper.
They can't just cash out.
They cannot sell that ETF on a Friday night, take the cash, and go buy a meme coin on a decentralized exchange.
There is no bridge.
There is no bridge.
Yeah.
The capital is trapped in the walled garden of the ETF.
Yeah.
And Wintermute points out this led to extreme concentration. The capital just didn't rotate.
So if you were holding a bag of speculative altcoins waiting for alt season.
You were waiting for a train that the institutions had disconnected from the engine.
Wow. Okay, that is a crucial distinction. It's not that the money didn't come in, it's that the money that did come in wasn't allowed to play in the rest of the casino.
Spot on. And speaking of the money coming in, we need to talk about the scale of this shift. Because there is a statistic from a Polygon executive that literally stopped me in my tracks when I read it.
This was the inflow stat from H. Gupta.
Yes. He estimates that institutions now account for 95% of inflows into crypto.
95.
95%. Retail is only about 5% or 6%.
That's not a takeover, that's a complete displacement.
It's a total regime change. Think back to 2017 or 2021. Those rallies were fueled by hype, by FOMO, by your Uber driver asking you about Dogecoin.
Yeah, it was retail-driven chaos.
Total chaos today.
Yeah.
It's structured finance. It's pension funds.
I saw in the Binance research report that the State of Wisconsin Investment Board is in. That feels significant.
It's huge. We aren't talking about crypto bros anymore. We're talking about state pension funds, banks like Morgan Stanley. It's a completely different beast.
Okay.
Binance noted that spot BTC ETFs now hold about 5.2% of the total Bitcoin supply. They're vacuuming up about 1,100 Bitcoin per day.
Which brings us back to the supply shock. That is significantly more than is being mined daily.
Way more. Demand is outstripping new supply. But because the buyers are institutions, the behavior of the price is different.
How so?
These guys don't panic buy at the top of a green candle because of a tweet, and they don't panic sell because of a rumor. They rebalance. They have investment committees. They have quarterly reviews.
It's slower. It's methodical.
It's slower moving, yield-bearing, and risk-managed, to quote the source.
That sounds, well, honestly, it sounds boring. And I don't know if I can fully get on board with this yet. Most people get into crypto for the excitement, for the volatility.
Right.
If I wanted boring, I'd buy a bond index or something. Why should I be happy about crypto becoming boring?
Here is the paradox, and this is where the "Where's my Lambo" crowd needs to pay attention. If you want the price to go to those astronomical levels, the $500K or $1 million predictions, you need trillions of dollars of new capital.
Not billions, trillions.
Trillions. And the people who control trillions of dollars, they absolutely hate volatility.
They don't want to have to explain to their boss why the portfolio dropped 20% while they were at lunch.
Exactly. Career risk is a real thing for these allocators. Binance research highlighted that annualized volatility in Bitcoin is hitting historic lows.
So it's calming down.
It's coming down. Bitcoin is behaving less like a rebellious teenager and more like a high beta tech stock.
High beta, meaning it moves like a tech stock, just slightly more amplified.
Right. It's correlated with the S&P 500, but it's settling down. And Van Eck released this incredible study on portfolio allocation that proves why this matters.
They were looking at the Sharpe ratio, right?
They were?
Okay, let's unpack that for the listener who skipped Finance 101. What exactly is the Sharpe ratio?
Put simply, the Sharpe ratio measures how much return you get for every unit of risk you take. It's the "is the stomachache worth the dinner" metric.
I like that analogy. A higher Sharpe ratio is better.
It's the holy grail for asset managers. And Van Eck found that if you take a traditional 60-40 portfolio, 60% stocks, 40% bonds, and you add just 6% crypto to it, you double your Sharpe ratio.
You double the risk-adjusted return. That seems almost too good to be true.
It does, but the math holds up. And crucially, you achieve this without significantly increasing your maximum drawdown. That is, the worst drop the portfolio experiences.
Okay, and that's the so what.
That is the so what for the listener. To a retail trader, low volatility is boring. To an institutional allocator managing billions, that Van Eck data is like catnip. It mathematically proves that Bitcoin isn't gambling. It's a responsible portfolio diversifier.
So we're moving from Bitcoin as rat poison to Bitcoin as a fiduciary duty.
Yes. But it also means the market structure changes. Institutions lend, they use options, they hedge.
And that suppresses the big moves.
It suppresses that wild, explosive upside we used to see. The God candles are harder to come by because there's always someone selling into strength to rebalance their portfolio. But it also creates a much higher floor.
So the moon is further away, but the floor is made of concrete.
A concrete floor built by BlackRock and Fidelity.
Okay, I'm starting to see the picture. The 4-year cycle is dead because the market is too big. The volatility is dying because the new owners are risk-averse. And the underdecked altcoin pumps are struggling because the money is stuck behind the walled garden.
That is a perfect summary of the landscape.
So the natural next question, the one everyone is screaming at their speakers right now, is how do we actually make money now? Because Buy and hold for 10 years is great advice, but I feel like our listeners want to know what the strategy is for 2026.
Right.
If the casino is closed, what game are we playing?
The strategy has to shift from gambling on price appreciation to strategic yield generation.
Yield is king.
Yes. The hedge fund report from Cayman Finance showed that 73% of managers are prioritizing yield generation. They aren't just betting the price goes up. They want the asset to pay them rent while they hold it.
This brings up the Ethereum versus Solana debate, doesn't it?
Yeah.
Because looking at the sources, Ethereum seems to be in a weird spot.
It is in a very awkward spot. The walled garden of ETFs has actually hurt Ethereum's narrative recently.
How so?
The current ETH ETFs in the U.S., they generally don't offer staking rewards due to regulatory hurdles.
Right, so let's break that down. If I hold ETH on-chain in my own wallet, I can stake it and get, what, 3 or 4% yield per year?
Roughly, yes.
Yeah.
You help secure the network, you get paid.
But if I buy the ETF, I get 0% yield, and I have to pay a management fee to BlackRock or Grayscale.
Exactly. You're paying fees to hold a non-yielding version of a yielding asset. It's objectively a bad deal. Wintermute noted that ETH ETFs have struggled with net outflows specifically because of this.
So the institutions can do the math?
They can. And they aren't going to pay for a product that is structurally inferior.
Meanwhile, Solana seems to be gaining ground.
Galaxy Digital's Alex Thorne mentioned this. Solana is eating Ethereum's lunch in terms of usage and mind share. It's winning the competition for the App Store of crypto because it's faster and cheaper.
Even without the huge ETF inflows.
Even without them, yeah.
So if I'm building a portfolio for this new era, do I dump ETH for SOL? Or stick with Bitcoin? What's the play?
Well, VanEck's optimal crypto portfolio study suggests you shouldn't just pick one. They ran the numbers to find the mathematical sweet spot.
And what was the split?
Historically, the best risk-adjusted returns came from a mix of roughly 70% Bitcoin and 30% Ethereum.
Interesting. So even with Ethereum struggles, the math says don't put all your eggs in the Bitcoin basket.
Correct. You want that beta, that exposure to the technology layer, not just the monetary layer. But there's another sector the sources kept mentioning as the next frontier.
And it's not a coin with a dog on it.
It is not. It's RWA, real-world assets.
This is where the boring money gets exciting. Tokenizing things like treasury bills, real estate. But we've heard about tokenization for years. It feels like a buzzword.
I know. But what makes 2026 different is the growth rate. The Markets Able report said this sector is growing at a 121% compound annual growth rate.
121%. That's insane growth. What's driving that?
Utility. Think about the treasury as a strategy concept. Companies like Tether or even non-crypto companies are realizing they have idle cash sitting in bank accounts earning minimal interest.
Or just restricted by banking hours. Banks close at 5 p.m. and on weekends?
Exactly. If they move that cash into on-chain treasury bills, they get 247 liquidity and often higher yield. They can move millions of dollars on a Sunday morning. It changes the velocity of money.
So it's about efficiency. It's not sexy, but it's useful.
It's about modernizing the plumbing of finance. The prediction in the report is potential $30 trillion market by 2034.
30 trillion. With a T.
With a T. That is massive. And this is why the boring stuff matters. If crypto becomes the back-end infrastructure for the entire global financial system, the value accrual is massive. But, and this is the key, it's not going to look like a Dogecoin chart.
No.
It's going to look like a steady, relentless adoption curve. It's not a pump. It's a migration.
So let's bring it back to the guy we started with, the retail investor asking, where's my Lambo? The answer seems to be, sir, this is a Wendy's boardroom.
Ideally, yeah. The summary here is that we are in the era of the allocator, not the gambler. The volatility dying isn't a bug, it's a feature of maturity.
It sounds like we need to lower our time preference. The get-rich-quick window might have closed, but the get-wealthy slowly and reliably window is wide open.
I think that's the perfect way to frame it.
But I hear a but coming.
You have that look on your face.
There is one lingering question that Wintermute raised. It's a bit of a provocative thought to leave the listener with.
Let's hear it.
It's about the mindshare problem. We talked about the walled garden, how institutional money is stuck in Bitcoin ETFs and not flowing down to the smaller coins.
Right. The broken trickle-down economy.
Wintermute suggested that for that wall to break, for a broad alt season to ever happen again, retail mindshare has to come back to crypto.
And right now, where is it?
It's in AI. The retail gambler who used to buy Shiba Inu is now buying NVIDIA calls or playing with AI agents.
They aren't looking at crypto. The speculative fervor has moved to a new, shiny object.
That is a scary thought for the crypto native. So here's the scenario. If retail doesn't come back, if they stay obsessed with AI, what happens?
Then we face the decoupling scenario. Bitcoin becomes digital gold, a permanent, boring corporate asset that slowly grinds up forever because institutions love it.
But the rest of the crypto market?
The thousands of altcoins waiting for a spark, they might just slowly starve to death.
Because there's no one left to buy the hype.
Exactly. The top survives, the bottom rots.
That is a sobering thought for the altcoin bag holders, but a fascinating one for the Bitcoin maximalists. It forces us to ask, do we own assets that have real utility, or do we just own assets that need a hype cycle to survive?
Indeed. It's a brave new world.
It certainly is. The cycle is dead. Long live the allocator. Thanks for diving in with us. We'll see you on the next one.